He has had millions of dollars in debt from a young age and just keeps piling on more. Today, we're talking with Keith Weinhold from Get Rich Education about the virtues of debt and why he wants more of it. And also inflation. Keith is going to show us how inflation isn't necessarily a bad thing, and in fact, how we can profit from it as a leveraged real estate investor. So, Keith, let's start with debt, shall we? Why do you have so much debt? Most people are trying to get out of debt and get rid of it. Doesn't this concern you at all? Aren't you afraid of having too much debt?
I have so much debt because I own so much real estate, and that's how I was able to afford the real estate. I think that real estate owners need to embrace debt. Why? The short story on that is with debt, you can do more. Instead of owning $1 million worth of real estate over time, you could own $5 million worth of real estate if you have 20% down payments on all of them. So why would you want to do that? Well, if real estate's going to appreciate 5% every year, I would rather have $5 million worth of real estate floating up with it rather than just $1 million worth of real estate. That's the big upside. That is called leverage, getting a return on other people's money. And this can sound scary to some people, but think about it. In this case, when I buy real estate right, which is where the rent income meets or exceeds all of the expenses, this debt is good because I have reliably outsourced every bit of my debt to tenants. And the more real estate I own, the risk actually goes down because a couple vacancies impact me less, and I'm able to own those assets in different geographic markets to actually reduce my risk this way. So yes, like you said, Seth, I have had millions of dollars in debt from a young age. I just keep piling on more of it and stacking on more. And this is definitely counterintuitive, but really when you think about it, building wealth is counterintuitive. You just can't do what the masses do.
Yeah. Now, let's talk about the risks with debt. The presupposition with the idea that debt is okay as long as there's going to be cash flow there to cover all the expenses and the debt service and all that. But what if there's not? What if rents go down or values go down? Does that ever happen? Is that anything you ever worry about, or how do you hedge against that kind of thing?
Rents rarely go down. They're extremely stable. Even in the 2008 global financial crisis, rents stayed stable. That's because people couldn't get loans then, and they had to become renters and stay in the renter pool rather than become owners. But if the real estate values go down, I had it happen to me in 2008. I actually bought a fourplex building for $530,000 in 2007. It went down to $480,000. That didn't feel good, and you didn't know where the bottom was back then either. But here's the thing. I was able to service my debt even while the building was temporarily suppressed in value because, again, I bought a property where the income exceeded all of the monthly expenses, and all those debt payments, again, were outsourced. But yeah, there's a lot of counterintuition here, Seth. You don't want to become over-leveraged. Over-leverage is a risk. Over-leverage means that you don't have enough income to make your monthly payments. You don't want to do that. You want to get yourself in a situation where you have a safety factor and you could reliably make those payments. But yeah, Seth, it's really counterintuitive. If you would point to a man on the street, you could even call that man me, and learn that he had $10 million in debt, you might feel really bad for him. Maybe he's a homeless person or something. But no, as we all know, net worth is assets minus debt. That person with $10 million in debt, which I like to call a debt decamillionaire, Seth, it's actually a target to shoot for. They might have $25 million in their asset column, the difference being a $15 million net worth. And a lot of prominent wealthy people make sure that they don't pay cash for their own home when they buy a new home. They know that they can get an interest rate and they can beat that interest rate out in the market, even on their own home. Mark Zuckerberg and his wife did that. They got a mortgage loan for a property when they could have paid all cash. Jay-Z and Beyonce did that. I do that too. Another way to think about a person that's in a huge amount of debt, say that man on the street with $10 million worth of debt, is when you think it through and you understand finance, that person would have to be pretty creditworthy to even get $10 million in debt. And the other angle with the debt is, we haven't even touched on it. It should be obvious to a lot of people. You're creating arbitrage when you borrow at a lower rate and invest at a higher rate. You profit on that spread called arbitrage. When you understand all the ways that real estate pays you, I've only touched on one, appreciation, and maybe a second, cash flow. When you understand all the ways real estate pays you, you can beat today's 7% mortgage rate. As long, again, as you don't become over leveraged. You have to be able to make those payments. You're doing that with tenant income streams.
Yeah. How much of a margin do you think is healthy? Like, how much more cash flow should you be making versus the debt payments? Like, at what point is it too close or not quite enough to be comfortable?
That's a good point. If you have a margin of at least 1 or 2% over the interest rate you're paying, that's a pretty good, safe, stable place to be. But you can often 2x or 3x the mortgage rate that you're paying. A lot of that tied up in the appreciation of the building. So you do need to stay liquid. And of course, paying down debt, like making an extra principal payment, gets you illiquid. It's difficult to get those dollars back. Financial freedom is created when you can take your equity and convert it into cash flow. Extra principal pay down does the opposite. It takes your cash flow and converts it into illiquid equity. So that's another important component of this debt, making sure that you have enough liquidity. Why don't I put it in some really simple terms here? I've talked with a bunch of numbers in the millions, and that might go over some people's heads, or, maybe you're thinking, oh, well, you can't relate to something like that. Think about what debt does for you. If you have a $100,000 rental property, yes, you actually still can find some of those. And say that property appreciates at 6%. It goes from 100K to 106K. Well, that's not very exciting. If you had paid all cash, you only have a 6% rate of return. But here's the thing. If you make a 20K down payment on a 100K property, and that 100K property appreciates up to 106K, your rate of return is 30%. How is it 30%? Because you have a 6K gain divided by just 20K of a down payment or equity. That's your ROI formula. You got the 6% gain on both the 20K down payment and the 80K that you borrowed from the bank. That doesn't go to the bank, that goes to you. And this is why compound leverage beats compound interest, which is a pretty inflammatory statement, but this is the wealth magnifying power of having good, responsible debt where those payments are reliably outsourced to tenants.
Yeah. Now, inflation. I know inflation is a big topic right now. There's a lot of that going on. You talk about why inflation debases your debt for you. Tell me more about that.
Yeah, that's a great question. Inflation debases your debt for you, and a lot of people don't understand that. Say that I have $1 million in debt. Inflation debases that for me because the bank doesn't ask to be repaid in inflation-adjusted dollars, only nominal dollars. Nominal means in name only. So with 5% inflation over time, whether that takes 1 year or 2 years, on that $1 million loan from the bank, I only owe the bank back $950K. And with 5% more inflation, $900K. And with 5% more inflation, $850K. So inflation debases your debt for you. And in real estate, of course, we know that your tenant is also paying down the principal balance at the same time. A lot of people just don't understand that. So inflation, it's like a silent debt killer, and a lot of people just don't account for that. So debt and inflation are two phenomena that make most people poorer. You've already learned now why you can use debt and inflation to make you wealthier. You're turning everything on its head here.
Yeah, that's huge. I remember the first time I realized, I was like, oh, wow. Like, if I know there's going to be inflation, like, I want to load up on as much cheap debt as I can. Maybe I can even make it go backwards, make money on the deal.
Right. Especially when you can outsource it and others make the payment for you. In that case, a cash flowing property, the tenant pays all of your principal for you, that pay down, all of the interest for you, and typically a little on top of that called cash flow. So I love debt in real estate. There are definitely bad types of debt. Credit card debt, where it's hard to arbitrage it and you have to pay your own debt. You can't outsource that. That's not what we're talking about here.
Yeah. Now, do you think there's always going to be inflation in the future? Like, it seems like the answer is yes in the short term anyway, but is this something you can pretty much always count on in some way, shape, or form?
Yeah, that's an important thing to ask about, Seth, because if we had deflation, which means a strengthening of the purchasing power of the dollar, everything that I just mentioned starts working against you. So you need to have a reasonable assurance that there's going to be future inflation. And take a look at this device here. Now, if you're listening in the audio only, you can't see this, so I'll describe it, but this is a debt badge. You can see these ticking numbers on the debt badge, this digital badge that you can wear on your lapel. Currently, it's a number between $36 and $37 trillion. This is linked to a computer and it downloads the latest number. And this $36 to $37 trillion in debt, which is increasing by $4 million every minute, by the way. All this public debt that we have, it helps ensure that there will be more inflation in the future. It's rather paradoxical that the most powerful nation in the world is also the greatest debtor nation in the history of the world. So how do we get out of debt? What do we do? This has become more of a problem. It's become more of a thing with Doge working on it now. We could default on our loans to China, but that's not very popular. It's very unlikely that we could do that. The United States could start selling our assets. Just imagine selling the Statue of Liberty back to France and then we would lease it back from them. I mean, it's not very likely that we're going to do that. The number one way to deal with our debt, Seth, is if you owed your buddy $5 million and you owned a printing press somehow. We're just going to print more dollars. That's what we have been doing for decades, ever since the dollar's been devalued from the gold standard more than 5 decades ago. We're going to have to print more dollars to pay back our debt. So the Fed, the nation, we have an incentive to create more inflation. The more dollars that get printed, which are needed to pay back our debt, dilutes the purchasing power of every dollar out there. That's inflation, and it almost helps guarantee that there will be more future inflation. At what rate, we just don't know.
Yeah. Do you think that's at all intentional, that, you know, it's in the U.S. government's best interest to print more money so that the debt isn't as painful? Like, is that it's part of the plan, do you think? Or is it just like, oops, more inflation just happened?
Sure, 100%. And it's the most expedient way to do it and deal with the debt. Think about the other ways to deal with the debt. They're really unpopular. Cutting Social Security, cutting Medicare, cutting Medicaid to help reduce the debt. That's not popular. You're never going to get voted in office. How about increasing our revenue by doubling the tax rate? Again, that's not very politically popular either. So surreptitiously, just continue to print dollars. What's the easiest way to pay for a new $1 trillion infrastructure program? And you might not even have to get votes for it. Just print more dollars, and that just diluted everybody's purchasing power. It's just another reason why you want more debt. And real estate investors are in a position to take on large chunks of debt. So I want that floating out there. Inflation keeps debasing my debt for me, just like $1 million loan on an apartment building, because over time, wages go higher, salaries go higher, rents go higher. It just gets easier to pay back. You want to get fixed rate debt. It debases both the absolute amount that you owe, $1 million on an apartment building in this case, and your monthly payment. That stays fixed. Inflation can't touch that. So the monthly payment is debased as well. So the fact that the Fed really has an inflationary mandate is tied to this fact that we have all of this debt, galactically big debt.
That's fascinating, Keith. Appreciate it. And that's all for this video, but I don't want you to miss part 2 of this conversation. We're going to talk about the massive baby boomer sell-off and what some people think is the coming housing crash, as there are more people dying than there are buying. You can find that video over on Keith's YouTube channel. I'll include a link to that right here on the screen and in the description beneath this video. If you're listening to the audio-only version, we'll get to it in a second. Be sure to click on that, and we'll see you over there.
Seth and I will see you over there on Get Rich Education right now.